Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Wednesday, March 11th, 2026, and we have a lot to cover today. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. Well, the dominant story right now is the escalating situation in the Strait of Hormuz. Three cargo ships were struck off Iran's coast, including one directly in the strait, and we've got three crew members missing from a Thai vessel. This is sending ripples through energy markets, with oil ticking higher to $85 as traders anticipate what could be a historic oil reserve release. The International Energy Agency is taking the lead on coordinating this response, with Japan stepping up to help stabilize supply. What's particularly interesting is how this is intersecting with the broader market narrative. We're also seeing consumer price data come in exactly as expected at 2.4% annually for February, which is keeping the Fed narrative relatively stable for now. But the real tension is in how investors are positioning ahead of today's CPI report. There's this wait-and-see mentality developing, and you can see it in how Bitcoin got stuck just under $70,000. Oracle provided some positive news with a strong full-year outlook that sent their stock jumping. But on the flip side, Campbell's is heading toward a 23-year low as soup and snack sales continue declining. The divergence we're seeing across sectors is really pronounced right now.
That's a significant development with the Strait of Hormuz situation. What does this mean for traders and investors in terms of positioning?
The key here is understanding that energy exposure is becoming increasingly important in portfolio construction. If oil stays above $80 a barrel, and it looks like it might given these supply concerns, energy stocks become one of the more compelling plays. But investors need to be selective because not all energy exposure is created equal. The geopolitical risk premium is back in play, which means volatility is likely to increase across the board. For those looking at defensive positioning, we're seeing some interesting dynamics where traditional safe havens are getting mixed signals. Gold prices are relatively muted despite the geopolitical tensions because the market is passing these developments against the inflation data we're waiting on. The smart money seems to be waiting for confirmation from today's CPI numbers before making big moves. What I'm watching closely is how the market interprets the combination of energy price pressure and the Fed's reaction function. If inflation stays sticky while oil prices rise, that creates a challenging environment for risk assets. On the opportunity side, companies with strong pricing power and those in the renewable energy space could see increased interest, especially as Europe explores capping natural gas prices and looks to accelerate their renewable transition in response to this new energy crisis.
That selectivity is going to be key in this environment. Steve, let's get into the economic numbers. What's the picture looking like this week?
Thanks, Robert. Let me walk you through what we've seen and what's coming earlier this week. On March 10th, we got the existing home sales report, which actually came in better than expected at 4.09 million units compared to the forecast of 3.89 million. That's a positive sign for the housing market, showing some resilience despite higher mortgage rates. Now, today is the main event with the Consumer Price Index release. This is a very high volatility indicator that measures changes in the price level of a basket of consumer goods and services, and it affects all sectors, especially consumer discretionary. The CPI index forecast is 325.41, up from the previous reading of 324.05. What this tells us is that inflation is still creeping higher on an absolute basis, and the market will be scrutinizing whether we're seeing any acceleration in the monthly rate of change. This number is critical for the Fed's policy path because if we see inflation remaining sticky or accelerating, it reduces the likelihood of rate cuts in the near term. The previous release on February 13th showed the actual came in at 325.25, which was below the forecast of 325.41. So today's reading will show whether that was just a temporary pause or if we're seeing a genuine moderation trend. Looking ahead to the rest of the week, Thursday, March 12th, we'll get initial jobless claims, housing starts, and building permits with a forecast of 1.35 million, and the trade balance, where we're expecting a deficit of $66.6 billion compared to the previous $70.3 billion. Then on Friday the 13th, we have a packed day with GDP expected at 1.4%, the PCE price index forecast at 0.4%, which is the Fed's preferred inflation measure, consumer confidence with a forecast of 55 compared to the previous 56.6, University of Michigan consumer sentiment, also at 55, durable goods orders expected to show 1.2% growth, and the JOLTS report forecasting 6.7 million job openings. That Friday data dump will give us a comprehensive view of economic growth, inflation pressures, consumer sentiment, and labor market dynamics all at once, which should provide significant direction for markets heading into the following week.
That's a heavy data calendar, especially Friday, Lizzie. Let's shift to crypto. What are you seeing in the digital asset space?
The crypto market is showing some really interesting divergence right now. Robert, Bitcoin is displaying bullish characteristics with analysts forecasting a return to $80,000 by the end of the month, We saw Bitcoin break above $70,000, and on-chain data from Santiment indicates we're back in FOMO territory. What's particularly notable is that Bitcoin ETFs added $251 million in inflows, with Goldman Sachs actually topping the list of XRP ETF holders, which shows continued institutional appetite. However, the retail interest remains weak according to on-chain metrics, even as the settlement layer usage is strong. This suggests Bitcoin is maturing as a long-term store of value rather than a speculative trading vehicle for retail. Exchange supply has hit a record low, and even with the Winklevoss twins moving $130 million in BTC to Gemini, the overall trend shows coins moving off exchanges into cold storage. The key factors to watch are Fed policy changes and how institutional flows continue, especially if we see any volatility around today's inflation data. Ethereum is presenting a more complex picture with what analysts are calling an adoption paradox. Network activity is reaching record levels, but the Ether price and blockchain fees are lagging significantly. Funding rates have flipped negative, indicating bearish sentiment in the derivatives market, and Ethereum has 3 times more holders than Bitcoin, even as traders eye the $2,000 level as a potential discount zone. The positive development is that Ethereum researchers are making progress on native rollups that could simplify Layer 2 verification and improve scaling. For Solana, the sentiment is relatively neutral. The most significant news is that Brera, a Nasdaq-listed company, approved a pivot to focus on building a Solana hub in the UAE while cutting their soccer team investments. This suggests potential institutional adoption, but we need more concrete developments before calling it a strong bullish signal. Overall, Bitcoin looks positioned for continued strength, Ethereum is in a wait-and-see mode despite strong fundamentals, and Solana needs more catalysts to break out of its current range.
Well, that wraps up today's Morning Bell. We've covered a lot of ground, from geopolitical tensions affecting energy markets to today's critical inflation data and the evolving crypto landscape. Remember, do your own research and consult with financial advisors before making investment decisions. If you found today's discussion valuable, please subscribe to the Morning Bell so you never miss an episode. I'm Robert, and we'll see you tomorrow.